Okay, good afternoon and welcome. Thank you for joining us today. Welcome to the New Capital webinar, Top 10 Investment Myths Busted, presented by Apollo Lupescu of Dimensional Fund Advisors. This is Catherine Barr. I'm the Director of Communications at New Capital, and I will be the host of today's webinar. If you have any questions during the webinar, you can type them in. There's a Q&A tool in your webinar menu, and you can type those in into that screen. We will be taking questions during the presentation if you have any questions that come up specifically about content. And then also we will do a session at the end. So you can ask your questions during the presentation or at the completion of the presentation. So welcome to the webinar today. We're so glad to have you here. For those of you who are on the call today who joined us or attempted to join us virtually on the annual conference a few weeks ago, you may know Apollo was supposed to do this presentation at that event, but we had some technical difficulties and were unable to bring Apollo in for that. But he was so gracious to reschedule with us and join us here today. So Apollo, thank you so much for your flexibility there and working with us. We're really happy to have you here. So thank you for joining us. And before we get started, I'm going to read the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. One more note before we get started. Is for those of you joining us on the settings, if you in your webinar settings, if you can up in the top right, we're recommending on the you can click on view, and on the view you go to the speaker view and then also click on full screen. That's going to be the best way to view the content and video today. So if you can make those adjustments to your webinar settings, again, it's in the top right of your screen. You will select speaker view and then full screen. So that is it. I'm going to pass that over to Leonard to introduce you to Apollo Lupescu. Thank you.
Good afternoon. Thank you, Catherine, and thanks for putting it together. And also to Hannah Weaver at Dimensional for her terrific work and all of our wonderful partners at Dimensional. It's great to have you here today. It's a beautiful day here in Houston. If you're coming to us from Houston or wherever you are, I hope everybody is doing well. Apollo, great to see you. Apollo is a nationally and internationally recognized speaker. He's a vice president at DFA, and he's delivered hundreds of lectures and seminars to financial professionals and individual investors on various investment topics. He's considered the secretary of explaining stuff at Dimensional, and that's pretty good because there are a lot of explainers at Dimensional, and so to be the secretary of it all is a big accomplishment. He's a knack for explaining complicated issues in a clear and understandable way. He's been with Dimensional for 17 years, and prior to that, he taught at the University of California. He has his PhD in economics and finance from UC Santa Barbara. He holds a BA in economics from Michigan State University, where he competed and coached water polo. Rumor has it that he is still an avid water polo player, but during the pandemic, he picked up surfing instead. And one of the best things about him is that he and I both share the same hairstyle. So that's one of my favorite things about Apollo. Apollo, welcome, and thank you for joining us today on this New Capital webinar. I'm going to turn it over to you now. Great to have you.
Good morning. And well, first of all, thank you so much for the invitation. I'm glad we can make this happen. And, thank you to everyone for taking the time this morning to attend the webinar. And by way of, talking about water polo, Houston actually has a very good very good team. It's called the Pigeon Vipers, I think, or something like that. But it's a very good team. I played them a few times, so You guys have water polo in your backyard.
Who knew?
Who knew? All right. So today, what I wanted to do is kind of walk you through some of these ideas in finance that typically when you listen to them at a cocktail party in the conventional way they're being presented, they're not always connected to data and evidence. So I'm gonna share with you some thoughts on some of these myths that I found that are important for investors to understand, and kind of disentangle them and kind of highlight what exactly is truth from fiction, what exactly is reality from just a narrative that exists out there that is not necessarily true. So I'm going to take a number of these topics and I'll go through them. But please feel free to ask questions. We'll try to leave as much time as at the end for these questions. And I'll start with something that is big top of mind right now for a lot of folks, which is inflation. I mean, we're all going to the grocery store, go to the gas station, and we see that prices are going up. But when it comes to investing, I think there's this notion that somehow inflation is connected to stock market results. That if inflation does one thing or another, markets will behave in a certain way. So what I'm going to try to do is show some data that is intuitive, that is visual, not hundreds of numbers, but just some easy visuals to understand. So what is the evidence saying about this particular myth that inflation and the stock market are closely related? Well, we looked at the data going back to 1990s and for the past 30 years or so, just to fit on the slide. And we looked at two things. What is the inflation, which is the yellow dot, and then compare that to how the market did, and the market being the S&P 500. But the bar represented by the S&P 500 is not just what the market did in that particular year, is what the market did above and beyond inflation. That is called real return. So when you take account of the inflation, how did the market do in a particular year? So what's kind of interesting to see is that there are some years when the inflation is very similar from one year to another, yet the market performance is wildly different. So what's interesting to see here is that there's no clear evidence to suggest that high inflation or low inflation in some way is tied to market performance. That's a bit of a myth. And the reason that it's a myth is because the stock market performance is driven by so many variables, so many factors, that inflation is one of them, but it is not a primary variable. There are too many things that drive the stock market. Inflation is certainly one of them, but what this is showing is not the primary driver of stock market returns. So let's start with that. That is not the driver of performance for the stock market. The second myth that I'm going to touch on is this idea that a successful investment experience is about about picking stocks. That the ability to pick some stocks, it really overpowers everything else. And that is, again, it's a myth that what stock should I buy is the definition of successful investing. That might have been the case at some point, but it's no longer the case. And why am I saying that? It was the case because when you buy a stock, you buy ownership into a company, and the value of the ownership is really what's really important to an investor. Am I paying too much or too little to own that particular company? And that is derived from having information on that company. And information is sort of the name of the game. And it was the case maybe 50 years ago, 60 years ago, that it took maybe minutes for information to get to investors. Maybe about 20, 30 years ago, it took seconds. Today, information travels almost instantaneously. It is hard to believe today that anybody can consistently get better information, can get it faster, and to basically have a competitive edge on a consistent basis when they go and trade in the market. So this idea that I need to own a stock and that's going to make me a successful investor, it's not necessarily necessarily the right way to think about it. And what's the evidence to that? Well, if you look at managers, mutual fund managers who try to do exactly that, it's quite staggering. If you look at different time periods, 10, 15, 20 years, there are thousands of mutual funds that you can look at. And the question is, how do these mutual funds do relative to their benchmark, to yardstick to which they measure themselves? Well, what's the first thing that's interesting is that even if you look at 10 years, about a third, more than a third of the funds actually disappeared. They did not even last for 10 years. And out of the, the entire bucket that we looked at, less than a quarter, 23% actually outperformed, meaning that 77% underperformed their own yardstick. When you look at 15 years, things don't look better. Fewer funds survive, and even fewer actually are winners. And when you look at 20 years, it's even fewer survivors and fewer winners. So the idea here being that if you are an investor and you want to know, well, what should I be doing? If you try to select a mutual fund that has an investment philosophy built around picking stocks, that, in my view, is no longer state of the art. There's so much evidence to suggest that particular approach is not really the way to go. So if picking stocks is not the way to go, then what else can you be doing? Because you still want to do quite well in the market. And what I'm suggesting is that if this is a square, if this square is the entire stock market, instead of cherry picking a handful of stocks, the alternative to that is something that came out of the academic research. And it's something that, we've been doing for 40 years. And the idea is that we want to own these stocks. We don't love or hate any one stock. We will consider these stocks, but we are not interested in understanding the behavior of each stock as much as the behavior of these stocks as part of a much larger basket, a much larger group of stocks, something that is known as asset class investing. So the myth is that I need to know what stock to buy to have great performance. The reality is that you're better off understanding the characteristics of much bigger basket of stocks. It's almost like if you look at a school of fish, every fish moves randomly, up, down, left, right, sideways. There's no way to predict which way a fish would move. But you get a much better sense and understanding of the behavior of the entire school of fish than any one fish. That's what I'm saying. It's the behavior of an asset class. And in that respect, if you look, there are different asset classes in the market. And the first one that was distinguished way back in the late 70s, early 80s, was a distinction that you have some very large, mature, well-established companies, which is what you see in the Dow Jones, or what professionally use more is a metric called S&P 500. And you could distinguish from smaller companies, also known as small caps, which are also part of the market, but they're not part of the S&P. So the idea is that we have a Shake Shack, which is a smaller burger chain, and you have McDonald's, and these two are different parts of the market. And we have a phenomenal book called The Matrix Book, and I'm sure the folks that are really familiar with it. That is the big book of numbers, and when you look at the over the long run at these two different investment asset classes and to see, well, how do they do? If you go back to the 1920s, in the Matrix book, what you see is that $1 invested back in the 1920s in the S&P 500 would have grown to, over $10,000. Which is a really nice growth, but when you look at the, like a dimensional index for small company stocks, the same dollar over the same time period would have grown to roughly about $36,000. So being mindful of what part of the market do I want to get is really important. And in the 1990s, there was also a research onto what about all these large and all these small cap stocks. Are they the same? And what we found is that they're not the same. That if you look at the price at which you buy a company, whether you look at the book value relative to its price, whether you look at cash flows, whatever accounting fundamentally can measure relative to the price, what you found is that over the long run, companies that have a low price, also known as value stocks, tend to do better than the more expensive counterparts called growth stocks. So knowing that small outperforms large, value beats growth, one part of the market that ought to give investors the biggest bang for the buck is small and value. And again, looking in the Matrix book for the dimensional small cap value index, what you see the growth of the same dollar over the same time period is about $90,000. So significantly greater growth, which means that as an investor, you can be very purposeful in allocating money, maybe perhaps a little bit more towards small companies or value, still have some large, still have some growth. But the way you allocate this is actually the primary determinant of expected returns in a portfolio. So it's not the stock picking as much as the asset allocation. So that's another myth that I think it's really important to debunk. The other myth out there is that when the market is very high, it hits an all-time high, or there's certain times when the market is just obviously valued very highly, so it's expensive. Maybe there is a good time to stay out of the market. And the way to mitigate against market downturns is to put your money in cash, wait on the sidelines for the market to drop, and then buy back in. This is also known, if you've heard this term, market timing, which means that there are times when you should be invested in the market and times when you should pull the money out of the market. And that's a myth that this is a way to mitigate against market downturns. The trouble with this strategy is of this myth is that if you decide to get out of the market, there's an equally important decision that you have to make at exactly the same time, which is when do you get back in the market? And that is the hardest question to answer because it's not one decision that you have to make correctly, but two simultaneous correct decisions, when to get in, when to get out. And I'm sure you've had enough friends or people who maybe got out of the market and they're a little happy about, I avoided some losses, but they ultimately ended up being just very stressed because they didn't know when to get back in the market. The market had recovered, and in fact, it was ahead, and they were still sitting in cash, not knowing when to get back in. And I'm not aware of anybody who can consistently make these two correct decisions. So what I'm here to tell you folks is that the myth of, there's a time to be invested and there's a time to get out of the market, that might make intuitive sense, but it's nearly impossible to implement in the real world. And even now, a lot of you might be hearing that the market is hitting an all-time high. And that is true every day. It's almost like it's another all-time high. Does it mean that you should sell because the party's going to end pretty soon and you just don't want to get burned? It's hard to tell, folks. When you look at the numbers, again, this is not based on opinion, but when you look at the numbers, it's an interesting story that it tells. If you invest your money now, let's say you have a bunch of money, you put it to work in the market right now at an all-time high, and then you ask the question, well, what's going to happen a year down the road? First of all, what are the chances that I'm going to have more money a year down the road, given that I invested an all-time high? And then if I'm going to have more money, by how much will my money grow? And we did exactly that research. We looked at, historically in the market, what do you see? About 1 in 3 months in the U.S. stock market, you're hitting an all-time high. So about 1 in 3 months, it's an all-time high, which is actually quite frequent. And then you ask the question, if you look a year after that the market hits an all-time high, what do you see? What percentage of time is the market higher, and by how much? And I'll let you put a number in your head and guess that. But when we actually did the research, what we found is that after the market hits a new high, about 81% of the time, 1 year ahead, you would make more money. The market would be higher than it was at an all-time high. 81% of the time. 4 out of 5, you would be ahead of the game. By how much? 13.9% on average. So if you look at the annualized returns after the market hits new highs, it's actually not a terrifying scenario. It doesn't look like screaming panic. But you do want to ask, well, what if I don't invest at an all-time high? What if I avoid the all-time highs and I invest in other months that are not all-time highs? How would my performance be different then? What would the results be then? And in that case, if you invest in any other previous month, what you see is, first of all, you have lower odds. You have a lower percentage of how many times your money would be ahead. So in fact, not only the percentage is lower from 81 to 75, but by how much drops significantly. And what's fascinating about this is that the myth is that an all-time high is a really terrible time to invest. What this seems to suggest is that from a statistical perspective, you are almost better off a year out after investing at an all-time high than investing at any other month. So this is for the 1 year, but what if you say, I'm not going to be just 1 year? What if I go 3 years out? When you go 3 years out, what you see is that that it pretty much evens out. It makes no difference. 3 years out, it makes absolutely no difference. The returns are pretty much identical. The percentages are pretty much identical. So this idea that investing at an all-time high is a bad idea is just not supported by evidence. So I think it's a really important one, because these days a lot of folks are concerned, I don't want to put my money and see the market drop. It's possible, but 4 out of 5 times actually the market goes up rather than going down. So one more myth, and by the way, folks, Leonard and Catherine, I kind of lost track of how many we have, but I'll keep going maybe for another 5 or 10 minutes, and then certainly be happy to take some questions and see what's on people's minds right now. But let's touch on a couple of more, because we have talked so much about stocks, and everybody wants to talk about stocks. But there's a different type of investment that a lot of you might have in your portfolio, which is called bonds. So let me first demystify what is the difference between stocks and bonds. Stocks are about ownership. And ownership is really the value of the ownership comes from the fact that you are entitled to part of the profits, earnings, cash flows that the company has. That's where the value comes from. You're a business owner. How much is that business worth? Well, it depends how much money it makes. But because profits fluctuate, so does the value of stocks in the market. So there's nothing really unusual. The nature of the stock market is to fluctuate because profits fluctuate. Bonds are not about ownership. Bonds are about lending. You are lending your money to corporations and governments, and you do that through a contract that specifies that you're going to give them the money, and in the contract, they specify an interest rate that they will pay you for how long they pay that interest rate, and at the back end, they give you your money back, the principal back. So whereas stocks are about ownership, bonds are about lending. And it's a very different animal because there's a lot more certainty, given there's a contract and a specified interest rate in what you get in bonds. And the first myth that I want to talk about is that when interest rates are low and you don't get paid as much in bonds as an investor, bonds don't really make sense. So is that the case? Is it the case that stocks and bonds, that the bonds basically don't make sense if the interest rates are low? And to look at that, it just, a lot of it depends, and it really is built on understanding why exactly do you hold bonds? What's the purpose of holding bonds? We talked about the stock market. If you look over the long run at the S&P 500, which is a very commonly used metric of the U.S. market, over the long run, the average annualized return has been in the neighborhood of 9-10% per year. But as profits fluctuate, as you have business cycles and so forth, there's a lot of choppiness, a lot of fluctuation around that average. In fact, the stock market, as far as I know, has never returned its actual average. So the average is just a mirage. It's just, it's a combination of good and bad years. But it's very rewarding. We talked about $1 being invested in 1920s, growing to about $10,000 to the end of last year. So a 10,000-fold increase. It's a really nice ride for investors. But it is a ride. It's a bit of a roller coaster ride. As opposed to stocks, bonds are much more about stability. Because there's a bond issued by the U.S. government. You give them the money. 30 days later, you get the money back plus interest. This is called the U.S. Treasury bill, the 30-day Treasury bill. If you look at what would have happened to your money if you had invested in these Treasury bills, it's quite remarkable. Over the long run, going back to the 20s, the return on these, the average annualized return, has been about 3 to 4%, which is a little bit above inflation. So what's interesting is that the Treasury bills have had a pretty decent return. But what's fascinating about them is that over the past 90 plus years, there has never been a single negative calendar year when you would have seen a negative return. There was not a single year when you would have opened the statement at the end of the year and say, "Whoops, I lost money." So every calendar year, you had a positive return in these Treasury bills. So in that respect, if you think about that, whereas stock market's about growth, this is about stability. If you think of an analogy, you go sailing. You put the sail up, stocks are pretty much like, make you go fast. That's the sail. It makes you go fast, but it also tosses you all over the place. Bonds are like the ballast. They slow you down on purpose, but they give you stability. And if you're young, it's okay. I get tossed around, it's fine. But maybe when I'm retired, I want some stability in my boat. I don't want to be tossed around everywhere. So that decision that's what advisors really work with you to figure out what's the right balance. And just to kind of highlight the point that the bonds have a role, even in low interest rate environments. When you look at the growth of your money in bonds and you compare it with stocks, it's very different. And again, I encourage you to put a number in your head. If you had invested the same exact dollar over the same time period in bonds, in the safety of these 30-day Treasury bills, what do you think the growth of a dollar would have been? Again, this book, which is a phenomenal book, it's something that that advisors have, and Leonard and Catherine can share with you. You look at the growth of the same dollar over the same time period, and what you see is that a dollar invested in Treasury bills by the end of last year would have grown to a whopping $22, and it's not missing any zero. It's $22, and I think it's really remarkable because what it says is that over the long run, the bonds were never there to make you a lot of money. The bonds were there for the stability. The difference between 22 and 10,000 is so staggering that gives you the sense that it's not necessarily why bonds aren't in the portfolio. Bonds are in the portfolio a lot of times because they do have a different profile. They do have a different characteristic relative to stocks. And that is that they don't move in lockstep. So again, role of bonds in the portfolio for sure. Even if you have low interest rates, the bonds are there to provide you some cushion to mitigate whenever the stock market drops. That gives you a chance to have some cushion there. So I can keep going, but let me check in with the folks, Leonard and Catherine. Any questions that might have come in, or any questions that you have, rather than me kind of keep rambling on.
Apollo, I'm wondering, I know that one of the things you discuss, I think, is Bitcoin in this, and maybe there's a lot of interest in this, and it's not an easy asset for advisors to give clients access to, because the funds have not really been built and permitted by the SEC to be traded. And so people have to kind of buy it in their own individual Coinbase accounts. And the rise in the value of Bitcoin is something that people are interested in. I'm wondering if you might talk to us about that and how we should be thinking about that.
Yeah, and that's such a timely topic, because I mean, I have family friends who are just, every time I go for a hike with them or a walk, they're like telling me how much money they made in Bitcoin. And it is true. There's a lot of money, a lot of people are making a lot of money in Bitcoin. So let's start by sort of demystifying a little bit and clarifying what exactly is Bitcoin, and why is it that what is it supposed to be, and what it has become? Does it make sense to have a part of your money in Bitcoin? So Bitcoin came about back in 2009. And it was an anonymous paper published by nobody really knows if it was an individual or group of people, and laid out this idea of Bitcoin as electronic cash. Now, when electronic cash came about, there was nothing new. There's nothing really new because, listen, Leonard, if you have miles on American or Southwest or whatever, those miles are pretty much electronic money. It's electronic cash that you can spend with the airlines. If you have points on your American Express card, if you have points on Hertz, if you put money on your Starbucks card, all of this is electronic money. In fact, most of our transactions are electronic money. But so the idea of electronic money was nothing new. What they're trying to do is actually something that was a lot clever. Which is not necessarily the idea of Bitcoin, but rather how you facilitate and how you create an ecosystem, a structure to keep track of who owns what, and to simplify the transactions between parties. So what I mean by that, if you go to a bank, there is, I mean, if anybody, if you think of a bank, there is a centralized ledger. And the bank keeps that ledger. And the ledger says, well, you have this much money, she has this much money, that family has that much money. And they control that. It's a centralized ledger that the bank has. And all the transactions are written in that centralized ledger at the bank. What this system created and introduced was a different way to approach the problem, and one that I do think is very smart, and it has legs, and it will change the world in some way. And that system is called blockchain. And the idea of blockchain, this technology, is saying that instead of having one centralized ledger, you're going to write the transaction of who owns what on thousands of computers around the world, which become basically ledgers of transactions. And every time there's a new transaction, it has to be validated through an algorithm, and then it gets written on all these ledgers around the world. So this way, there is no way to falsify any one transaction, but it's a decentralized ledger that nobody really owns. It's a decentralized ledger system, and that introduces a couple of really interesting benefits. The first one is that you can have direct transactions from one party to another without intermediaries. I can just send you the money directly, and that's a good thing. But the other one, which is not so good, it introduces anonymity. That the fact is that everything is coded like a Swiss bank account, that it's all codes, it's all numbers, and you can become anonymous. So the idea was to create a currency that would compete with the dollar and sit on top of this technology called blockchain. So Bitcoin is just one application of what blockchain can be used for. In fact, there are thousands of currencies, cryptocurrencies out there, Ethereum, Dogecoin, all of them sit on top of blockchain on the same kind of a technology. So if you look now, and we're like, 10 years after, 12 years after, has Bitcoin become a currency? And the answer is absolutely not. It is not a currency. Why? Because a currency has to have three features. The first feature is that what you can buy from one day to another, from 1 month to another, is roughly the same. That is, the feature of a currency is that it's a store of value. If you look at your checking account, what you can buy today is roughly the same that you could have bought last month. It doesn't fluctuate in value. It's stable. With your checking account, it's stable in what you have in there. What about Bitcoin? Well, let's look at days, and I just looked at the statistic recently. You look at days when the Bitcoin or the stock market move above and beyond plus or minus 2%. So it's basically, you say, extreme days. I can either make money or lose money, but at a pretty big threshold, negative 2% or plus 2%. In other words, you look at the Dow. It would mean that plus 2%, if the Dow is at 36,000, you can either make more than 720 points, the Dow goes up by more than 720 points, or drops more than 720 points. So these are pretty extreme moves. And what you find is that on a day-to-day basis, the magnitude of how many days we see Bitcoin lose over 2% or make over 2% is several times higher than the stock market itself, which is risky to begin with. So it's not clear. It's clearly not a store of value. The second thing, you just look every day how much it fluctuates in value. It's crazy. One day you buy a Tesla, the other day you buy a cup of coffee. It's just crazy how much it fluctuates in value. The second thing is that the prices are quoted in that. I'm not sure if any prices are quoted in that. And the third one, it's a medium of exchange, meaning that it can be used to make purchases. Well, I just read not too long ago that it's estimated that 3/4 of all Bitcoin transactions in volume are used for illegal activities, ransomware, kidnapping, drugs, you name it. So that anonymity actually has a downside because so much of it is driven by Bitcoin. Years ago, there was this website called, I think, Silk Road that the FBI raided. And the only reason that Silk Road existed was because it had the ability to make transactions in Bitcoin, and it was all illegal stuff. So, in other words, what I'm here to tell you folks is that Bitcoin, it is not a currency. It is not a currency. And it shouldn't be, because what's the problem that it's trying to solve? Really, it's a solution in search of a problem. What's the problem that it's trying to solve? But what is it then? And this is where we go to the next thing, which is, well, at some point people said, well, maybe I can make money out of Bitcoin because look, it goes up in value. So people think of it as an investment. So if it's an investment, why not treat it as stocks, bonds, and real estate? And the answer is that there is a very big difference between stocks, bonds, real estate, and Bitcoin. If you buy a stock, you buy ownership into a business. Let's say you buy a share of Apple. Well, Apple has real people, real products, real profits. And because of that, I can get a sense of what will I get paid as a business owner, and decide if the value of that ownership it's worth the price that I'm supposed to pay. Is it a good deal or not a good deal based on that? When you buy a bond, you know what the interest rate is and what interest payments you're going to get, and you can decide, is that a good deal or not? When you buy a building, let's just make it real. You buy a building. If you're going to collect $1,000 a month for that building, and somebody's asking $10 million for that, you can say, no, this is way too expensive because you looked at what am I gonna get paid? In other words, stocks, bonds, and real estate can be valued. They have a valuation behind them that drives what the price is. What are you paying today? The idea of valuation is cornerstone to successful investing. You need to know, am I paying too much or is it a good deal? And you can do that with stocks, bonds, and real estate. Trouble is that Bitcoin has none of that. Bitcoin has no value whatsoever, no valuation, because it doesn't produce anything. The only source, the only reason when people are buying Bitcoin is like, well, why should you get paid more in the future? Well, I think people are going to be willing to pay more in the future. Why? Nobody can answer why, because there's no source of value. It doesn't produce anything. It's not a productive asset. And because of that, the big difference is that I look at Bitcoin and I cannot tell you if 60,000 is a good deal or $60 is a good deal. I have no idea because he has no valuation. It's a purely speculative investment. And the closest that he got to me was an old friend of mine when I was in college. Ended up getting into this Beanie Baby craze. You remember that, Leonard and Catherine? Remember Beanie Baby craze? Where you bought the Beanie Babies and then you sold them, and he made tons of money because everybody wanted to buy them and they're not easy to find. And I got caught up into that because like she was making so much money. Well, why am I not making all the money? So I bought all these. And it turns out I bought them just before the craze went bust. And I ended up with a closet full of Beanie Babies. And while I was in the middle of it, it makes so much sense. Why wouldn't I want to do that? And then afterwards, I took a second, like, what exactly was I thinking when I bought all these Beanie Babies? And it kind of like, it didn't occur to me that this is not going to last forever. So the way I look at this right now is that I have no idea how long this craze is going to last. I don't see the reason. It's not a currency. It's not an investment that can be valued. And what I tell folks is that if owning Bitcoin says something about yourself, if it gives you the joy of watching the price go up and down, if it's the excitement of the market movement, if it tickles your ego and it gives you something to talk about at a party, then, absolutely go buy some on the side, because there are a lot worse things that people are spending money on. But I would say do it knowing that this is more on the speculative side, when I hope that everybody makes a lot of money. But if something doesn't work out, it's not going to really impact your family's future. So I distinguish between, the assets that are invested in a robust way based on valuation, which is stocks, bonds, and real estate, versus this more speculative play, which it could last. And then the last comment that I would make is be careful with the risks. Some that are, easy to figure out, and some that are not. I'll tell you one risk that I know a few people who encountered it, and it's real. Because you're not at a bank, you have a password and a wallet. And if you lose the wallet or the password, it's an electronic wallet. If you lose the electronic wallet, something happens to the computer, or you lose the passkey, that money is gone forever. You cannot call anybody and say, "Hey, I forgot my password." If you don't have a custodian account. And if you have a custodian account, then basically you trust that somebody will not take your money, because it's all anonymous and somebody can just tap in there and take your money. And there is a lot of fraud that is happening in these type of accounts. So all in all, it's a long-winded answer, but it's such an important question, distinguishing between, is it a currency or not? It is not a currency. Is it an investment or not? Not in the sense of stocks, bonds, and real estate. And should I be owned this? Yes, if you do it for fun, entertainment, or just play around. And are there risks associated? Absolutely. And you ought to be careful, particularly with the logistical ones. And then not forget taxes, not forget about the government kind of really stepping up and looking at folks who own Bitcoin.
And there are people who would say that Bitcoin has some of the same features as owning gold, correct?
Huh?
Sort of digital gold, and then the question is, well, what is gold? Is it an investment, and what is its expected return? And I'm assuming that the folks at Dimensional have looked at that and said that we don't know. We don't expect any return out of gold, as you said, because there's no yield, there's no income, there's no rent, there's no coupon payment on it, and so it becomes purely a speculative place.
And what gold, you're absolutely right. And in fact, Warren Buffett has over the years, over and over, made the same exact comment that if you put a big piece of gold on the table, you come back 10 years later, nothing had changed. If you take that money and you buy farmland, you can have crops, you can sell the crops and make money. You can do other productive things with it, where gold does none of that. So, it's not just us, it's Warren Buffett is kind of mentioning the same thing. There's a difference with gold. And the one difference is that to some degree, gold can be used for jewelry or industrial purposes. And in that respect, if there's a demand for that, I don't know how much it is, but you can say it could have some productive aspects. And I want to touch on one more thing, because I've heard some folks talking about, listen, gold is valuable, and so is Bitcoin, because there's a limited quantity. That as opposed to the government printing dollars left and right, at least Bitcoin has a limit of how many Bitcoins will be issued. So for the folks who don't know, the intricacies is that when that person created the system, it said that the most Bitcoins you can have are 21 million Bitcoins. And in a few years, I think 20 years, whatever it is, we're going to reach that threshold. So the idea of being scarce, that not being unlimited supply, that somehow is supposed to be good as opposed to the dollar. In fact, it's not a good thing, but Leonard, it's a bad thing. It is what led to the demise of gold. Up until 1971, the dollar and the gold were linked. In other words, you could not print a dollar unless the government had some gold in the bank. And that gave a lot of folks the comfort that the government is just not going to print money willy-nilly. And in 1971, something happened. Economists basically came in and said, listen, we're in big trouble because the economy is growing and growing and growing. We just don't have enough gold to print the dollars. And the economy is just going to start collapsing because we just don't have enough dollar bills for the multiplying population, for the economic growth of the country. So in 1971, we cut the link between gold and the dollar. Up until 1971, it used to be something called the gold standard. We abandoned that in 1971 because a limited supply is actually terrible. And it's kind of the same thing with Bitcoin. If you think of Bitcoin, and these are all the Bitcoins that you have, and then you have, let's say, bottles of water, and you have these many bottles of water. Well, as the population grows, and you have more and more people, and you have a bigger production of water, you're going to have more and more water bottles, but this supply stays fixed. So what has to happen is somehow the price of water has to get cheaper. The prices have to go down, and that's called deflation, and it's a terrible thing for the economy. In other words, the money supply has to grow somehow as the economy grows, and that is not happening with Bitcoin. That has not happened with gold. So in fact, when people are looking and saying it's a positive, that it's a limited amount, I would argue it's exactly the opposite. It's going to be the demise of it because it cannot keep up with economic growth and population growth. You need to grow a currency as the economy grows. That's just the bottom line. There's no economist would ever say no, that's not the case. It has to be the case.
Catherine, any questions have come in, or should we go to some more myths on the list?
Nothing has come in yet, but everyone, if you do have any questions on any investment topics, feel free to type them in, and we can keep going. Or Leonard, if you had anything else.
I don't know, maybe another myth or two, Apollo, and then we'll conclude.
Yeah. So let's talk about a myth that I always found interesting is that as an investor, you are you should invest in U.S. companies because we're part of the U.S. and this is what we know. And international stocks might not necessarily be a good idea. So global diversification is not really needed because we have our own market is so strong here in the U.S. So why not just invest locally? And so the myth that local U.S. investing is the way to go as opposed to being globally diversified. And I'm not sure, do you get that question, Leonard, sometimes of people saying that why are we investing internationally, particularly since it has done so well lately over the past 10 years? It's certainly outperformed a lot of other markets. And
we talk about it a lot, and I think people understand it, but I think it'll be useful for you to give the theoretical underpinnings for people to see. Yeah.
So first of all, let me talk about just the idea that when we look at investing, it is not investing in different countries. We're not investing in countries. That's a broad term. The investing happens at the company level. So we're looking to invest in different companies that might be based around the world. And in that respect, if you take a map, a global map, and you replace landmass and with the value of all companies that can be bought and sold in a particular country. So instead of landmass, you plot the value of companies in each particular country. This is what a world will look like. The US is the largest on this map because there are about 3,500 different companies in the US, and together between Apple, Google, Microsoft, Coca-Cola, McDonald's, all the Exxons and all the Texas companies, it represents about 57% of the value of all companies in the world. But what it means is that 43% and over 10,000 different companies are based abroad, and they are also investment opportunities. So the idea is that it's absolutely correct to think that we should have the bulk of our money, the preponderance of our money in the US, because look, we are the biggest stock market by far in the world. But does it mean that we should not own anything abroad? And my perspective, really kind of became clear just a few weeks ago when I went down. I live in Los Angeles, and I went down the street here close to UCLA where I live, and I was kind of shocked by the diversity of what we buy. And what I mean by that, you go on the street and you certainly see a lot of US made cars. There's a Ford, there's a GM, there are Teslas on the road, for sure. So it absolutely makes sense to own these companies, because not only do we own them as stocks, but we also buy them at the dealer lots. But at the same time, I also saw a bunch of German cars, the Beamers and the Mercedes, the Porsches. And it kind of made me think, hey, we buy these companies, and it makes sense to have Ford and GM. Why not BMW and Mercedes? And not only that, but when you look at the Dodge, the Jeeps, the Chryslers, these are now brands owned by an Italian company that trades in Milan. It's not even traded in the US. These are cars that we think of being US brands, and they are US brands, but you buy them in a different country. You have the Japanese cars. We all know there are plenty of Hondas and Toyotas. And even brands like Jaguar and Land Rover, these are owned by an Indian company. Volvo, until not too long ago, and Lotus were owned by a Chinese company. You certainly have the Korean companies. And what you see is really that it's not just about what we sell to foreigners, but what foreigners sell to us. And to me, it became really interesting to think about it. If it makes sense to own Ford and GM, why not BMW and Toyota? And what's wrong with that idea? Why do we have to limit ourselves only to this? So it's a global marketplace, both in terms of what we sell abroad, but also what's being sold to us. We are familiar with these companies. Why not just purchase? Why just purchase their vehicles when we can also purchase a bunch of ownership into those companies? And there's certainly a benefit to this, because if you look from from country to country, it's the case that it moves pretty randomly. But as I said, over the past 10 years, the U.S. Going from 2010 to the end of 2019 to 2020, for 10 years, the U.S., which is this bar in yellow, was towards the top. It performed really, really, really well. Not as well as New Zealand, but still very well. And that's when a lot of folks are wondering, why not just put money in the U.S.? Well, it turns out that if you just go back one decade, the decade previous, the U.S. was towards the bottom. And the question that I got was, well, why are we investing in any U.S. companies? Because they're not doing as well as all the other countries. So it's very, very interesting to look at and see that this global diversification can really be beneficial to investors. And it's not just the last 1 or 2 decades. In fact, we're able to go back to 1970. And as I said, if you look at the last 10 years, 2010 to 2020, the U.S., which is in blue, outperformed international, which is in orange. Now, that's the average annualized during that decade, average annualized return over that decade. Now, if you go in the 70s, international stocks, significantly outperformed the U.S. It was exactly the same case in the 80s. And in those periods, people were very happy to be deploying their capital across the world. In the 1990s, we had the tech boom, and that's when the market really jumped in the U.S. But that was followed by, the hangover, the lost decade, when for a whole 10 years, the U.S. Market was negative. So to me, again, it is something that it's not consistently the U.S. is on top. There are times when it is. It's great to have it, but it's also nice to have that international diversification. So to me, it's a combination of intuition and data. Does it make sense intuitively? Yes. Does the data support it? Yes. And the last comment I'd make is, this is not about let's put all our money in international. No, this is about creating some sort of a balance. That every advisor and every client might have a different allocation between U.S., international, developed, and emerging. There's not a perfect allocation, and you have your own. But Leonard, typically speaking, do the bulk of the money, do the majority of the money go into the U.S. or international markets in your portfolios?
Well, I would say we do a very, very focused job of trying to make sure that we are internationally diversified. And really, I think the data that you've provided, Apollo, is really, really important in showing why that's the case and why it's important. And so I think our clients are understanding of all these points. But I think it always helps to reinforce it. I think the charts that you show and all the charts you've shown today, I think what's really important for people to take away from the presentation is that it's not just ideas, it's ideas that are supported by statistics and ideas that are supported by data. I thought it was absolutely fascinating, the all-time market information. That was the first time I'd seen that. And when markets keep hitting highs, that is really sort of the one question I get. Well, what's coming next? It's got to fall. It's got to come down. And maybe the market will. Inevitably, it's going to have a time when it has a difficult period. But it's a totally fascinating slide that you show. Yep. That if you really look at the statistics, it's a coin toss.
Coin toss. Well, can I finish with one just fun myth that I'm going to wrap it up, and it's a myth that I want to be careful because I'm not engaging in politics, not at all. But I've heard over and over this idea that one political party is better than the other, that when elections come along and you should be looking and saying, well, having one party or another. So there's a myth out there, and depending on which side of the politics you are, the myth to you is that Democrats are doing better. The myth on the other side is that Republicans are doing better. And I think that this idea that the politics and the markets are related, the elections and the markets are really intertwined. It's interesting to explore from a data perspective, and exactly what you said, not an intuition, not a hunch, but what does the data say? And last year we had a lot of calls because, as you know, there's a Democratic unified government control. And unified doesn't mean that they're holding hands and singing Kumbaya. It's just that, one party controls the White House, the Senate, and the House. And we wanted to see, when you look at the data, what do we see when it comes to that particular idea of how do the markets do during different unified government controls? And we looked and going back to the 1920s, in the S&P 500, the Republicans also had the control of the White House, the Senate, and the House. And over this long time period, there were 13 years in which they controlled these branches of government. And during these 13 years, the average return per year in the stock market was 14.52. And this is the just a simple average on the years that they controlled these three branches of government. Now, Democrats, did they also have that? And yes, they did. The Democrats also controlled the White House, the Senate, and the House. But it wasn't for 13 years. In fact, it was for a lot longer. It was 34 years that they had control over these branches. Now the question is, how do the markets do during these 34 years of Democratic unified control? What does the data say? And when we run the numbers and we ran them over and over and over again, the answer was 14.52%. It is identical to the second decimal. That's how little it matters. And again, it's a myth out there that a lot of folks are clinging on that, hey, one party or another is better than the market. It just, the data's not there.
But it is a much bigger sample size, right? Is there anything to that?
You can parse it out. Again, the point being that you can look at it. Just the reality is that politics, as well as inflation, are one of the many, 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 many variables that impact the market. And just to try to pinpoint and try to provide an explanation of why the market did well or bad based on inflation or politics is way too
very difficult. We have one question that's come in, right, Catherine?
Yes. So one came in, I'll read that out. Is one argument is that currently inflation is only from two things. One, increasing fossil fuel prices, or two, increasing price of automobiles, both new and used, resulting from supply chain shortages and pent-up demand. Thus, this inflation does not have anything to do with money supply, Federal Reserve / federal budget. What is your opinion?
Yeah, and again, it's kind of good to look at data. So when you think about inflation, it's a very, very important question. When you think about prices and how they move, there are two drivers of prices. One is the what's called the demand. In other words, consumers buying things and government buying things and companies buying things. So if there's money put in the economy through the stimulus or whatever, a lot of folks are saying, well, perhaps as the money reaches consumers spend the money, that's going to lead to perhaps inflation. And is there evidence to suggest that? It's really hard to tell, but I'll tell you two things. One is that when you look at the last time we saw a big infusion of capital in the economy, and that was after the financial crisis. In 2009, not only that we had a big stimulus, not as big as this one, but still a big one, we had TARP, Troubled Asset Relief Program, but there was a third element to this, which is a program called quantitative easing. And quantitative easing was deployed by the Federal Reserve Bank. And over the course of 5 years or so, it's estimated that between 2009 and 2014, the Federal Reserve put about $4.5 trillion with a T, into the economy. And back about 10 years ago, there were very, very similar questions that I would get from investors. Well, surely all this money is going to lead to runaway inflation. It's going to be crazy out there, and this is going to be a disaster. And what's interesting is that the long-run inflation in the U.S. has been about 3%. The Fed's target has been about 2%. And over the past 12 years since quantitative easing was put in place, the average inflation in the U.S. has been roughly around 1.5%. Half the historical average and even below the Fed's own target. In other words, it's hard to make an argument that stimulus by itself is going to lead to inflation. It wasn't the case in the last time that we saw a big infusion of capital in the economy. Now, today, you also pointed out very correctly that it's not just the demand, but there's also what's called the supply side, which is the economy's ability to produce. And right now, it is constrained a little bit because of the coronavirus protocols around the world, because of supply chain issues, shipping, all the things that we know. And you hear numbers that the prices are going up 5-6%. Well, you compare the price from last year to this year, of course they're going to be higher. But it is to the point that the gentleman or the lady made, is that it is attributable to some categories like energy and used car prices. But the question quickly to touch on before we, I don't want to hold anybody hostage, is what's going to happen forward with inflation? A lot of folks are curious about this. And I can tell you there are two different scenarios that are perfectly valid. In the first scenario is that this is a transitional phase when all of us, the world economy, is going from the pandemic to the post-pandemic, and during this transitional phase, you're going to have these problems, you're going to have these hiccups, and once you get past the next 12 months, whatever the number might be, then we'll go back to what it used to be, which is the same rate of growth in prices that we had before. The economy will kind of go back to where it was. That's the first narrative. And it's backed up by some folks saying, look at the price of lumber. When sawmills closed and there was not enough lumber, prices skyrocketed. And then when the sawmills reopened, they tanked by about 2/3. So it is one argument that you can make. The other one is that, no, this is going to be more persistent. Companies are getting used to past increases. Workers are getting paid more. So this is going to be high inflation sustained for a little bit longer. I can spend half hour arguing very, very eloquently for each one of these scenarios, but the reality is that neither myself nor the president of the United States or the Fed chairman, nobody really knows which one of these will play out. But there is a referendum that is taking place every single day in the market, a referendum in which investors are voting with real dollar bills on what they think will happen and which one of these two scenarios is more likely to happen. And that referendum is the way you see the referendum is there's something called the break-even inflation rate, which is a number that all bond investors know, and it basically reflects something that is priced into bonds. And I'm going to share with you the data, which is published by the Federal Reserve. It's the Fed collects this data. It's everybody knows about it in the investment world. And this is the break-even inflation rate. This is a live website. And what is the break-even inflation rate? And I'm using the 5 years numbers. Is what market participants expect inflation to be in the next 5 years on average. And the reason I think this is so important is because this is not an opinion piece. This is not a forecast. This is a signal that is sent, that's being sent by everybody who's voting in this referendum with dollar bills. So what do we see this as being? So if you go back a few years, as I said, inflation was unusually low, less than 2%. And then when the pandemic hit, it went the other way, that almost like people were scared that the prices might not increase at all, which is a bad thing by itself. But as the economy reopened, as things are kind of going back to normal, where we are as of last night, as of Thursday, November 18th, it's about 3.1%. So what the market's signaling is that over the next 5 years, as of today, with all the information that we have, we expect inflation to be about 3.1%, which is higher than we've seen over the past 5 years, but it's pretty much spot on with the long-term average of inflation in the US. In other words, perhaps the anomaly has been too low of inflation. And if we go back to about 3% over the next 5 years, that's the expectation that we have as of today with all the information that we have, which is higher inflation. But what the market's signaling is not something in the panic zone. What's interesting, though, is that this referendum takes place every day. If you look at the beginning of the year, the expectation was about, less than 2%. That's kind of what the market expected with the information that we had back then. As new information came in about stimulus, about taxes, about supply chains, it went up as high as 2.7% in May. And then about 2 weeks later, it dropped to about 2.3. And then, as you see here, it kind of went up to 2.99 in late October. And then a few weeks later, it went on to 2.8. And then now it's at, it used to be at 3.17. Now it's at 3.11. So this changes every single day. So if you're curious, this is probably the most up to date in terms of what to expect about inflation. It's not an opinion piece. It's not my opinion. It's basically this market referendum where investors vote with billions and billions of dollars. And to me, this is probably the most legitimate way to think about what should I expect over the next 5 years when it comes to inflation. And the answer is a little bit higher than we've had in the past, but not necessarily in the panic zone.
So the chart really shows, Apollo, that that this is where the current expectation is. It could go up, it could go down, it could stay the same. Nobody knows which direction. There is no human on earth that can look at that chart right now and say where the next move of the chart is going to be.
Absolutely. And every single day, you got it. Every single day, there's new information about supply chains, about unemployment, about workers coming back or leaving the work. Every single day, all this information is being incorporated into this referendum. That's so important, is exactly that. Every single day, whatever you think, whatever expectations you might have, this is put into that number. And it changes because every day we get new information. So from here, it could go back down. Like, remember in May, it was at 2.7. And then, people are like, oh, it's going to keep going higher and higher and higher. And then, 2 weeks later, it was at 3.1. So 2.3. So again, this number changes, and it's so important to keep it in perspective. And yeah, it has been going up, but it's not clear that it's going to go up or it could go down. I just don't think that something that anybody can control. But as an investor, and you talk about your plans, do you guys put in some inflation assumptions in the plans when you've constructed it for your clients?
Yes, we do. We put in a 3%. We put in a 3% rate of inflation. We can change it, but we basically have gone with the 3% rate that approximately inflation has run at since the 1920s. Is the Matrix book, which you showed everybody. That's really, I think it's maybe 2.9 is what it's run since 1926 or so.
2.9. It's exactly right. 2.9. You know, again, but you've done this before while inflation was still, you know, 1 or 2%. You know, it's typically that's the interesting part, is that you've looked at inflation. It's nothing necessarily new.
Yep. Well, look, everybody, we're a little bit over, and I hope that you enjoyed the presentation as much as I did. I absolutely, really got an incredible benefit and value, Apollo, from not just asserting that these are myths, but showing us the slide, you know, the data that is behind it. That's really such an incredibly powerful thing, and really the reason that we do so much work with Dimensional, because there is data and research behind the things that you all tell us about, and so much of what goes on in the world of investment is without foundation. And so for us to be able to see that it's not just an assertion that's being made or something that's a supposition, but to be able to see the slides. And we're totally thrilled with your slide technology. Catherine and I were saying, wow, look how he goes between the slide and the video. We got to get us some of that, because it's really incredible. And so thank you so much for appearing today and coming back after we were not able to get the technology together the day of our conference. And we will look forward to hopefully having you back at some point in the future. It was a really tremendous presentation, and hope everybody has a wonderful day. So thank you so much for your time and your generous insight.